So we're going to start with the fundamentals here. What is private equity? It's a term that's used widely, very commonly, and candidly, it's become a bit taboo as of late. And the reason for that is there's so many private equity firms. There's over 6,000 active in the United States today. And with that and anything else at that volume, you're going to have the good, the bad, and the ugly. But fundamentally, how these firms operate, they have three principles or pillars, if you will. The first thing they do is raise money from investors. That's endowments, pension funds, high net worth families and individuals. They take that money and they put it to work, ultimately buying with the goal of operating and growing companies, de-risking the business by adding a board of directors who has the experience in the industry, leadership, the know-hows of how to scale a business, adding capacity, so putting more capital to work and expanding operations geographically or within its existing footprint, pursuing acquisitions, and building out an executive leadership team. All of those things make the business less risky, making it worth more money. And ultimately, their goal is to sell that company at a later date for increased value for shareholders and their firm. Now, a question we get asked a lot is, who does private equity sell to? And from the outside, it can be a little bit challenging to distinguish between the lines of what this ecosystem or what we call the food chain looks like. And so what we see a lot and who we work with a lot are lower middle market firms. These firms are the one doing the platform creation. They're buying the $1 to $2 to $3 to $4 to $5 million EBITDA businesses, and they're bringing them together under one brand. They're building out that first layer of executive leadership. They're putting in place early technologies. They're doing the gritty work to bring 8 to 10 brands together under one umbrella and make them a unified business while keeping their local brand equity. Those firms, I'm sure you've heard of some of these, Shore Capital and Alpine, are in the lower middle market. Typically, what will happen is after they've established a platform that's operating well and is ready for the next partner, they'll transact or transition that business to a middle market private equity fund. These firms have more capital at their disposal, will write bigger checks, and candidly has the expertise of taking a business from, say, $25 million of EBITDA to 100. And so they can continue to grow with that business. Ultimately, after they've achieved their goals, they're going to look to transact that as well. They could go adjacent to another middle market firm who maybe is eager to get in the industry, or they can move upstream into an upper middle market or a large cap fund. And they ultimately desire to exit via an IPO to a strategic and sometimes even a buy and hold strategy. But there is defined players within the industry and a natural progression for firms to move through. And that's how private equity can realize value throughout the process. The question, the $1 million question or millions of dollars questions is, how does private equity actually make money? And there's two standard ways in which they collect dollars on their investments or return on their investments. One is what's called the management fee. It's much like what a wealth manager charges its clients to manage their assets. In private equity, the standard amount is 2%. So in this scenario, we're going to say a firm raises 500 million. They charge those investors 2%. They're collecting $10 million in revenue. Really, the intention for that is to build out an acquisition team, sales team, an operating team, so that they can not only complete acquisitions, but support those acquisitions in their growth journey. And where they make most of their money is what's called carried interest. So if we carry forward that example, and we say they took $500 million committed capital, they invested it, and now 7 years later, they've been able to exit all of those investments. And at the end of that, they turned 500 million into 1.5 billion. The first thing they have to do is give their investors the money back. They do that, they're left with $1 billion of equity value they had created through their investments. They share in that 20% to every 80, or 20% of every dollar that they give back to investors goes to the private equity fund. So in this scenario, they made $200 million. And now you can imagine that check size can go up significantly if they generate a higher return, if they're investing more dollars. And that is why investors like it, because your interests are aligned, right? They're making money when you make money. But also, this is why private equity has created one of, if not the most billionaires of any industry, because if they do their job correctly, the returns are significant and meaningful for these firms. Now, for those of you who have explored the rabbit hole of private equity, you've maybe talked to groups, you've invested, you've heard terms like general partner, limited partner, committed capital, fund, platform, add-on acquisition. And if you don't live it day to day, it can be a little bit tricky to understand maybe what all of those mean. So this is a visual illustration of how it looks, and I'll walk you through each piece separately. So your private equity firm is the general partner, right? They're responsible ultimately for the operations of the business. At a high level, they're not in there turning wrenches, but they're responsible for it. They own it. Limited partners are those high net worth individuals, pensions, endowments who give the private equity firm committed capital and allocate that to a fund. A fund is generally a pool of committed capital intended to invest in a specific industry. So a private equity firm can have multiple funds, and they'll have an industrial fund managed by an industrials team, a business services fund managed by a business services team, et cetera, et cetera, et cetera. When those funds invest in companies, they're creating platforms. When those platforms go acquire more regionalized local brands, those are add-on acquisitions. Now, I'll give you a real-world example. There's been a lot of publicity around Guild Garage Door Company recently. Guild was the platform. Companies like Garage Door Doctor would be the add-on acquisition that folds into or comes under the Guild platform or umbrella. And for those who have continued to explore the rabbit hole of private equity, you've certainly heard the term rollover equity, or what is called the second bite of the apple. A couple things that I want you to take away from this slide, and trust me when I say we could spend an entire hour on rollover equity alone, but we'll skip ahead to just the important points here. There's what's called a waterfall. A waterfall is essentially just a list of who gets paid what and when. So on that, you have your debt and your equity structures. I don't think we need to get into the details of it, but you can have different forms of debt with different interest rate from different lenders. And at the very bottom, carrying the most risk, but the most upside, is equity. So when you're considering either an investment or a partnership, first you want to understand the waterfall. In other words, who is getting paid before the equity holders, and how much is it? And how likely is it we can pay them off to even realize a return on the equity? Once you get to the equity side of things, you now have to understand the cap table. Not all equity is created equal. Equity can have different restrictions, upside, options. And so it's important to understand where you're sitting on the cap table, and ultimately who gets paid first and what, and why you are where you are, and what incentives exist there. But also what's most important is to understand that equity can and has gone to zero in partnerships before, or can't be liquidated. Not all equity is created equal. Not all equity will grow. And so it's truly important, just like any investment, to understand what you're investing in, who you're investing with, and what has to happen for you to realize a return on your investment.